Welcome, everyone. We're going to give people a moment or two to join us. We're going to be a small group today, which means we'll be able to do a lot of questions and answers. In just a minute or two, I'll do a little bit of housekeeping, and then we will get started. Looks like at the moment we have 5 attendees as well as the panelists. So as always, we record these. If you're not comfortable being recorded, you should log off. I have to tell you that because of the law. Okay, let's get started. This is our, I think it's really our third in the series of webinars, in addition to the one we did about just preparing for meeting with Mike. I'm not going to introduce Mike Gellman. You've all, I think, met him before, but he is a very experienced nonprofit CPA who does a lot of training for nonprofits, and he's just been a huge resource to our members. If you are considering doing a one-on-one session with him, you may remember that the partnership will cover the costs of that we actually encourage you to do it because we think it's important for your organization at this time. And if you haven't signed up for it and want to, reach out to Polani. Polani will put her email in the chat box, and she will help you get scheduled. You do it in 2 sections. So first you pull together a batch of documents and we give you the link to the webinar and the list of the documents that you need, and Mike reviews those in advance. Then you spend a half hour going over them with him and deciding what your plan should look like. You go back and prepare it, and then Mike meets again with you for a half hour to review your plan and help make sure that it covers what you need it to. This webinar is good both for people who are meeting with Mike and for people who aren't. And while we've got our general title up there on the screen, this particular one is focusing on, actually, I'm blanking, Mike. I'm going to turn it over to you and let you see what it's focusing on.
The balance sheet here today will, it's all part of our financial health and continuity.
Great. Before you do that, one more thing. Everybody, put your questions in the chat box and I will bring them into the webinar at the appropriate time with Mike. So we're not going to wait until the end to do questions. Put them in the chat box and I'll be monitoring it for Mike. There we go. Now I turn it over.
Also, I'd like to remind everybody today is 60 minutes. Our last one was 90 minutes. Remember, we went a little bit longer. So we're going 60 minutes today. And then just as before, my contact information is on the front screen here and on the SC4 Nonprofits website, Sustainability Education for Nonprofits. We're posting new information every week. So since we last met, there's a number of new pieces up there that you should go ahead and check on. It's posted some new pieces related to June 30 year ends and messaging. I think it'll be really important. And we'll cover some of that here today. Okay, so today we're going to go over the balance sheet. And remember, I've said that the health of an organization only shows up on the balance sheet. We get tunnel vision on the income statement where the budget shows up. But, you know, you could be having a great budget year and be really tight on your balance sheet. Cash can be in a difficult position and such. Deb, could you remind everybody, I think maybe it might be good to mute. I'm getting some background.
Yes, by all means, everyone, if you could please mute yourself. I will also check and make sure everyone's muted. We are going to take questions, but we are going to do it in the chat box.
Or you can unmute if you have a question. Yep. Okay. So we're spending the whole day today on the balance sheet. You'll hear me say this a number of times today. The health of an organization only shows up on the balance sheet. Okay, we get tunnel vision on the income statement. Excuse me. Okay, and that's good. We will always watch over our budgets and everything. But you can be having a great budget year and your balance sheet can be underwater, really struggling. You can be having a horrible budget year, losing money, and your balance sheet is okay. And we have the operating funds and such to support that. Okay, so that's what we're going to be doing here today. We're going to finish with going through some examples on the screen. And Deb will make a copy of this PowerPoint available to you after the conclusion of today's webinar. Okay, so let's go ahead and get started understanding the balance sheet. And before we start this question, and Deb, I'd like to get some feedback. This is a perfect sized group to get a nice conversation going. I like to talk about the difference between accrual basis accounting and cash basis accounting. Would anybody like to unmute or in the chat say what they think cash basis? Let's start with cash basis accounting first. What's your understanding? Can you give me a simple description of cash basis accounting? Very short sentence. Any responses there? Deb, you're muted.
There we go. We don't have any responses in here, but let's give people a moment to type. And you can.
Yeah, or you can unmute. Okay.
Yeah.
Cash basis accounting. I know we see it's mostly for smaller organizations. We're going to talk about the pros and cons of that a little bit.
Yeah, we're not getting it. I think
Okay.
we're going to need you to define it for people.
Okay, good. No problem. Okay, simply put, cash basis accounting is based on money going in and out of what? In and out of your bank account. Okay, so your bank statement becomes your financial statement. So if you have a check in your hand and it's not in your bank statement, it won't be recorded. So when you make a deposit for that contribution or that registration fee or that fee for service, that will be recorded as income. When you write a check or pay something or pull money out of the bank, that will be recorded as an expense transaction, okay? So it's very simple. It's easy. It works for very small organizations, especially organizations that are all volunteer run. The example I use is for like small PTAs. I used to work with National PTA. There are 23,000 PTAs around the country. The average elementary school PTA only has a few $1,000s running through it. It's what I call a shoebox organization, and cash basis works. But there's a couple problems with cash basis accounting. It's not GAAP, generally accepted accounting principles. And here's my problem with it. Deb, can I pick on you for the example? Okay, you're muted. Yep. So sure. Deb, so if I walk up to you on the street and I pull out my bank statement and it says I have $2 million on it, and I show you my bank statement and I ask you this question, yes or no, Deb, look, I have $2 million in my bank statement. Am I a healthy organization? Yes or no? Can you answer that question?
I have no idea what you owe.
Yeah, and you don't know. I could be very healthy or very weak. I could be sitting on $4 million of accounts payable and be underwater or whatever. You see what I mean? And that's the problem with it. We don't know. The other problem is, Deb, let's pretend like it's the end of your year. You're working with a small organization. You're the executive director. You have a $5,000 surplus at the end of the year, okay? It's December 29th. You have a 12/31 year end. But sitting on your desk is an American Express bill for $8,000. Cash basis, if you pay that bill that day, it'll throw you into a loss. If you hold that statement and pay it 2 days later in January, it'll ensure that you have an income, this year. So you see, it's open, so you can manipulate the bottom line that way, the timing of it and such. Okay, so that's a little bit of cash. Let's go to accrual basis accounting. Okay, an accrual basis accounting is based on the matching principle. Okay, that revenue is recorded when earned and expenses are recorded when incurred. When you actually deposit the money or when you actually pay for the bills doesn't matter. Those will be handled through accounts receivable and accounts payable. Accrual basis accounting is GAAP, generally accepted accounting principles. It's the accounting method that most nonprofit organizations adopt. It's very hard, if not impossible, to get an audit of an accrual basis statement because it's not GAAP. It's an except for decision. And it's even harder for grant receiving entities to receive funds that aren't on accrual basis. Okay, and I've seen organizations get in real trouble when they say they're on accrual basis, but they're also on a cash basis. So it's the matching principle. Money's recorded when earned, expenses are recorded and incurred. When the money comes in and out of the bank account doesn't impact that. Now, as you'll see here, I always like to jokingly say accrual basis accounting is part of the Accountants Full Employment Act because it creates a ton of journal entries and makes the balance sheets very complicated. And that's what we're going to go through here next. Okay, so let's go to the next slide. So today we're going to heavily concentrate on the balance sheet, assets, liabilities, and net assets. We'll briefly talk a little bit about revenue and expenses, and we've been covering these in other webinars and such, and we will at the end. But we're going to stay here. We're going to look at the accounting systems through the eyes of a financial statement, and we're going to concentrate on the balance sheet. And the first set of accounts on a balance sheet is the assets are at the top, liabilities in the middle, net assets on the bottom. Now, Deb, I'm going to ask a series of questions here, so take a look. So you ever wonder about the order of line items on a balance sheet? Do they come in, do they show up on the balance sheet in alphabetical order? No. Do they show up in a random order? No. What is the order that one line's lifted above another line on a balance sheet? There's a real order. Does anybody have an answer to what the order is?
Put it in the chat box if you do. I'm monitoring it for Mike.
Okay, any answers so far?
Nope. Let's give him a moment.
Okay.
Mike Sheehan says liquidity.
Oh, perfect. And that's the order that drives the order when we list items on. So the most liquid accounts, like a cash account, will be listed at the top. And the least liquid accounts, like inventory, prepaid expenses, will be listed on the bottom. So they're in order of liquidity. Very good. That's just a little something you want to keep in mind, because when you see this order, the stacking on a balance sheet, that tells you something. Okay, the top three lines are the most important: cash, cash equivalents, and investments. Okay, let's go through those together. Okay, think in order of liquidity. So the items that go into cash, or the accounts that go into cash, are your most liquid types of cash accounts. Anybody want to suggest what would be in here? What would we put on the top line? It's your very typical, what type of account goes here?
I'm looking for responses.
Yep, give everybody a minute.
Jennifer Ferguson says checking account.
Perfect, yeah. Checking, your business operating, your main account, okay? That's always listed at the top. The only other thing that might be listed there would be like a savings account, or if you had a separate payroll account. That's it. Okay, I'm going to say something before I go into these other two. Cash equivalents and investments. All nonprofit organizations should have an IPS. That stands for Investment Policy Statement, okay? And I can share some examples and things and such with you. But on the IPS I like to use, the first page will define these three buckets. How much we want to have in our checking account. We shouldn't just have an unlimited amount in there. How much we would have in our cash equivalents, the middle bucket. And then the third bucket is investments. So under a definition first, what goes under investments? And Deb, I'm not sure if there's anybody on the line that has long-term investments. I know I've seen through the TAs, some of the participants, I'm not sure who's on, have them. But investments, there's three buckets there. There's fixed income. Those are things that earn interest, okay? Like certificates of deposit, bond funds, and such. Then there's equities, stocks, stock mutual funds. And the third bucket in there is everything else we call alternative investments. It can be everything else that you could hold in under investments. It can be commodity, even some real estate, and all different types of hedge funds and things. Cash equivalents are things that sit in between investment and cash. So if our cash IPS says we want to have most all the mid-sized organizations would like to keep 1 to 2 months of their budget in the checking account. And once that overflows, if we had just gotten a whole bunch of memberships in or something, that would flow down into cash equivalents where we'd hold 2 to 4 months. So if you had 1 to 2 months in here, 2 to 4 months in here, then you could be potentially there to hold long-term investments, funds you don't need for a while. Okay? Cash equivalents is not a checking account and it's not your long-term investments. The things that sit in here are just holding accounts, CDs, certificates of deposit, and such, where we park money in that we don't need today, but we might need in a month or two. Okay? So take a look at it this way. And which of these three lines, Deb, I'm looking for an answer here from people. Which of these three lines would you put a 5-month, 5-year, 60-month, $100,000 CD, certificate of deposit? Which of these three, a 5-year, 60-month, $100,000 CD? Any answers?
Let's give them a moment.
Five-year, 60-month, $100,000 CD.
I'm not getting any answers. Oh, wait, Stephanie says cash equivalent.
Okay. 5-year, because it's a 5-year CD, our intent is to hold that. That would actually go down in the investment line. But Stephanie, where would you put a 3-month, 90-day, $100,000 CD? That would go where? That would be the middle bucket, right? Cash equivalents, everybody there? Okay, and if you had a,
Stephanie agrees.
yep, okay. And then if you had a 1-month, 30-day, $100,000 CD, that would go into cash. So can you see this cascading event? It's not just the type of vehicle, it's really the intent and how long you would hold it. And anybody who has a long-term investments accounts, they'll actually have a small cash position inside there. You might even have a small checking account in there. Because it supports investments, it doesn't go up here. It's actually part of the diversified portfolio and it stays in investments. Okay? Now, having these IPS statements is very important because it gives you some targets for what you want to keep in here. And we're going to play a game called Too Much, Too Little. So Deb, we're going to need people to answer this. Okay, let's do the easy one. Can you have too little cash? Everybody should be saying yes. It's not good to have too small cash account balance, okay? Now let's do the harder one. Is it bad to have too much cash? A really high balance in your checking account? The answer is yes. And what's wrong with having a ton of money sitting in your cash account? There's 3 issues with it. What's wrong? Anybody, what's wrong with having a ton? It's a good problem to have a lot of cash. But what's wrong with having a ton of money sitting in the cash account?
Dan Fisher says it's not insured.
Okay, really good word. We have safety risk. That money, and if you think about it, your checking account, everybody can get at that account number. Okay, it's not safe to keep a lot of money in there. You could there's a lot of things that could happen. Okay, we got safety risk. There's 2 more risks. What are they? Anybody else offer an answer?
Giving them a moment.
Well, this is Jennifer Ferguson. Can you hear me?
Yes,
Yep.
Jeff, go ahead.
I was just going to say, if it's in like cash on it too, and if you've got a lot, that means you can't really earn a lot of interest on it, depending on how interest rates are going.
Perfect, Jennifer. So you have return risk. So now we have safety risk, return risk. And let me give you what the third risk is. My third risk is, I call it C&T, confidence and trust. That a well-managed nonprofit has a cash management and investment policy statement and has policies for not keeping too much or too little in each of these accounts. See what I'm saying? So when you look at it this way, you're always balancing all 3: C&T, confidence and trust, safety risk, and return risk. When it comes to cash, the thing that I'm most worried about is safety risk, because I know checking accounts can be invaded quickly and accidents and errors can happen. I like to keep this down. But it's nice when we can push the money down into here because we can earn a little more interest. And it's really hard to steal or have a mistake with a certificate of deposit. And then, of course, if these are both full, we can push it down into here and earn even more. Okay? So I like when people know that, you have these policies in place. C&T trust is very important. And then one more thing on this, when you're messaging people, if you're talking to an auditor about these, they're mostly worried about safety. You're talking to an executive director, they're mostly worried about, rate of return. And you talk to a board, it's really seeing confidence and trust that you have really good accounting policies and procedures. Okay, let's go down to accounts receivable and pledges receivable. These are really interesting for nonprofits. Nonprofits have both of these. For-profits doesn't have one of these. So accounts receivable. Do for-profits have accounts receivable? And the answer is yes. This is for what we call an exchange transaction, offer and consideration. If you sell someone a book for $10, okay, they buy the book, they give you $10, we have offer and consideration. If you ship them the book and send them a bill and they have to pay you later, we still have the sale, but now instead of debiting cash $10, we're debiting accounts receivable because they owe us some funds. Okay, that's how accounts receivable work. Okay, for nonprofits, too much, too little. We got to be careful here because, and we should see very much accounts receivable on nonprofits. You could have people showing up for an event, a community, a community organization could have a clinic going on or something, and they bill people a small co-fee. Pledges receivable is a different story. Only nonprofits. You don't see that in for-profits. And that's for people who, it's a promise to give. People make a promise, a pledge to give X number of dollars in the future. Okay? Is there anyone on this call who has pledges receivable on your balance sheet? Anybody working in this environment? Deb, can you take a look at that?
I don't know. Some of them might have pledges receivable. I don't know for sure.
Okay. It's pretty typical out there where, especially there's so many examples we can talk about. You see it oftentimes with groups that are, doing annual appeals, and for like a capital campaign, if a nonprofit's getting ready to build a building or something, they will get people to make 3, 4, 5 year pledges. Okay. Pledges receivable are interesting. They're really good. So what's good about having high pledges receivable? That means, people don't pledge to crappy organizations. You must be doing something really well if everybody's making a lot of pledges. What's bad about it? It's not cash, and you have to collect them. Okay, so think of it this way. If I were to give you a check for $2,000, unrestricted contribution, you would debit cash $2,000, and you credit contributions unrestricted $2,000. If I make a pledge for $10,000, you credit contributions $10,000. You still got the contributions on the income statement, but now we debit pledges receivable $10,000, and we have to collect that. Now, Deb, what's interesting about pledges receivable? They're a bit hard to manage. 2 people could make $5,000 pledges. One person could make a pledge for $1,000 a year over 5 years. That's a $5,000 pledge, correct?
Right.
Okay. And the person next to them could just make an outright $5,000 pledge. Okay.
Right.
2 years later, the person who made the $1,000 a year pledge still owes $3,000, correct? Okay, and that's a current pledge because they're just paying $1,000 a year. The person who made the $5,000 pledge 2 years later hasn't paid it yet. Now we got an issue, right? Maybe
Right.
they'll pay it and it'll be okay, but it's starting to get old. You see what I mean? So you can't just look at the balance. You also have to look at the age of the items in there and managing that. Now, I do think, especially during this, COVID-19 crisis and everything, managing pledges receivable is a real burden. It can make your balance sheet, and we'll see this in the examples, look good, but it's not cash. We got to collect those. And something that might have been collectible because people made the pledge 2 years ago before the crisis, they might not be in the same position now during a crisis, right, Deb? To
Right.
pay off that pledge. So what was rock solid a year ago might not be rock solid today, and things can change. And that's the problem with pledges receivable. So the too much, too little is interesting. If you have a lot of pledges, that's good. People are excited. People don't pledge to crappy organizations. What's bad about it is not cash. If you have low pledges receivable, that's good because you've collected on all your pledges. What's bad about it is you're not getting new pledges to replace them. You see? So here it gets a little more muddied watching over these. Okay, other receivables. If you had a highlighter, I'd have you highlight this. In crisis times, this number can go up because things that pop into there are usually bad. If you do advances to your employees, because they were furloughed or they're in trouble and they need an advance, that would show up in here. If you make mistakes in the accounting system and you double pay or triple pay something, you got to look for a refund. That shows up in here. If you're struggling and you have to cancel insurance policies to get refunds and things, and you're waiting for the refund, they show up in here. So Deb, whenever I see other receivables, I like to see 0. You know what I mean? So just be aware. This can be an indicator of some issues.
Right.
Okay. I think everybody has heard the word prepaid expenses before, but would anybody like to give a quick description of what a prepaid expense is?
I'm looking to see if anybody's putting one in there.
Okay.
Well, nope, nobody's put one in.
Okay. Everybody has prepaid expenses. These are things that we pay for now that we're going to get a future benefit for. So it's like before the year starts, you do your annual insurance policies. You pay for them ahead of time. You pay membership ahead of time, different things. You put a deposit down on an event or something you're doing in the future. Those are prepaid expenses, okay? The problem is they're not cash. They're typical where you see them all the time. But if you pay $2,000 for insurance for next year, cash goes down $2,000. Prepaid expenses go up $2,000, okay? And your assets are still the same, but it's not cash. And inventory is a form of prepaid expense. Those are things, items we bought that we keep in inventory we're going to use or sell later on. They're either feast or famine with nonprofits. Groups that run clinics that have medical supplies, like inventory can be very expensive and be very hard to manage. Okay, and even a lot of it has to be kept under refrigeration. And so, it's really painful if some of that inventory expires, we don't use it by the expiration date, or if the electricity went out and we lost it. Okay, so inventory can eat a lot of cash, and we'll see this in an example. Okay, any questions here so far? Okay, let's go to the next page. Fixed assets, this is the big one. A lot of people get scared about these. So, Deb, I'm gonna ask everybody a question. Ready? What's the difference between $5,000 of office supplies and $5,000 of office furniture? What's the difference between $5,000 of office supplies and $5,000 of office furniture? Any answers?
We've got an answer here. Mary says furniture is depreciated.
Okay, keep going. Any more answers? What's the difference? That's part of the answer. Why do we depreciate it?
Let's see if we get a response.
Think about office supplies. How quickly do we use office supplies?
Mary says loss of value over time is why we depreciate furniture. Supplies get used up as we use them. So we can actually still have a depreciated item when it's completely depreciated, and it can still work. And once we've used up a supply, it's gone.
Right. And another way to say that in a little bit shorter sentence is the office supplies are a consumable that we're probably going to use fairly quickly. And the furniture we're going to benefit from over multiple years. And that's why we have fixed assets, is to take an asset that we're going to benefit from over multiple years and spread the cost over those years. Yes, they sort of get used worthless after a while, but it's really spreading the cost over the years we're going to use it. So if we normally keep office furniture for 10 years, we'll spread that over 10 years. But if we blow through our office supplies in 10 days, we just expense that. That's a consumable. Okay. Not all assets follow the same life. I have organizations that buy computers and they're depreciated and they hold on to them many years. I have other organizations that have, they're climate-based organizations. They're activists in the field in third world countries. Their computers have a useful life, those laptops in the field, of about 5 months. So we're expensing that because they're under very harsh conditions and things. So it's your useful life, okay? And then they're spread. The other place I like to point out is a lot of the organizations I've seen in the TAs have office leases. If you make any improvements to the office property, you'll spread the improvement cost out over the remaining years of the remaining life of the lease. Okay. Deposits on those same organizations that have leases, you got to put 2, 3, 4 month rent deposit down ahead of time. That shows up here because it's long term. And we can have other goodwill and contingent assets here from leases. Okay, so that wraps up our assets. Let's go to current liabilities. Liabilities, just like less like assets, are listed in order of liquidity, but in reverse. These are the things that we have to liquidate the fastest. Accounts payable sits at the top because those are things that we owe and we're going to pay within a few days or few weeks. Okay, but sitting right below accounts payable is accrued expenses. Anybody want to guess what this one always befuddles a lot of people? Anybody want to tell me what the difference is between accounts payable and accrued expense? Notice they're both sitting at the top, which means they're both going to incur a liability pretty quickly. Any answer on accrued expenses, Deb?
No answer yet. Let's give them a moment.
Okay. And I do one, and it's okay if you don't know this one because this is a little esoteric.
Yeah, we don't have an answer. So
Okay. Okay, here's the way I look at it. Accounts payable are things that we owe that we get an invoice for. Accrued expenses are things that we owe that we don't get an invoice for. We get a bill from FedEx for delivery charges. We accrue vacation accruals for people who are not taking off vacation right now, which is becoming an issue in this COVID-19 crisis. It's sort of a little bit of a sucker punch here. Everybody's working very hard. There's no place to go for vacation, so nobody's taking any vacation leave. Consequently, we're building up a liability of unused vacation time. Okay, we get a bill for telephone, internet charges. We have to accrue retirement contributions, matches, and things. So you see where I'm going? Bonuses, and these are the actual bills. So get an invoice here, don't get an invoice here. I worry more about the accrued expenses because we don't get an invoice, we could miss them. And accruals are usually big numbers. You might miss a $20 FedEx bill, but a vacation accrual could be thousands of dollars, and it can really hurt when that catches you unexpectedly on an audit. So we got to keep an eye out for these accruals that we have to make. Okay, let's do the too much, too little for accounts payable and accrued expenses. Okay, can you have too much accounts payable? Yes, we don't want that to get real high. It's very hard to pay those down. Organizations that are struggling can be sitting on 3 months, 4 months, 90 days, 120 days of accounts payable. That's really difficult. Okay. Can you have too little accounts payable? And the answer is actually yes. And the same three things, safety, rate of return, and C&T come into play. That organizations with good cash management policies don't just pay every bill as soon as it walks in the door. If we pay bills on Wednesday and Deb, you show up with a bill on Thursday, it's just going to get into the system, okay? But the reason we do that is so we can check the bill over carefully, make sure all the approvals correct, budget lines up, and then we queue it up for payment at the right time. So it's safety first. We also have ROI because if we don't have to pay a bill for 30 days, we can sit on that and it can help our cash position and we can earn a little more interest. And then C&T, confidence and trust, that we're a well-managed, run organization and we have procedures for processing and paying our bills. Safety, rate of return, confidence, and trust. Okay. The last big one we need to talk about for nonprofits is deferred income. Okay. And this, I know I've seen it on a lot of statements, and we'll see it on the examples here in a little bit. Okay. What is deferred income? Deb, I'll give them 20 seconds on this. I'm just watching the time, but I'd like to see if anybody wants to take a shot at deferred income.
all right, let's see what we got.
This
You
is
can-
Jennifer. Can you hear me? It's easier for me to just
Go for it.
like,
Yep, we can hear
I
you.
think for us, deferred income is usually like, or it used to be when we've received revenue, but we haven't incurred the expenses yet. So we're waiting to incur those before we recognize it.
Yeah, that's correct. I say it's slightly different. You receive revenue for an event or something that hasn't happened yet in the future. You know, so someone registers for an event for next month. They pay their membership dues early. Okay. You know, they buy a service ahead of time and then you do the service later on. Okay. So you see this membership income is almost always comes in here. A lot of people pay the membership before the membership year starts. You see this colleges and universities meal plans, you know, people who pay for a full year meal plan money for someone who's enrolled at the school. Okay, and then that's going forward. Deferred income is your friend. It's always good on every front. People paying early is a good thing. People pay early usually because they have confidence and trust in the organization. And it's really good for cash flow to get these funds in up front. It doesn't break a law if we use the money now to help pay bills, but we got to make sure we can cover those expenses when that event happens later on. So the funds are fungible. I call it hand in the cookie jar. You know, if you get a lot of money up front for next year, there's a temptation to use it now. You know what I mean? But bird in hand is better, right, Deb? You always want to, nobody ever complains when you get the money in early, you know?
Right. Getting
No.
it first is always good.
Yeah, but there's a temptation there. Deferred liabilities, interesting. The way we have to record leases now, multi-year leases, we have to book the full liability of those leases up front because, you know, if you default on a lease, you can and will get sued for the balance of the lease, and we show that up front now. I don't recall, is there any grant giving organizations that are re-granting or grants? I thought there were a little bit. Yeah.
They don't in general, but they might in a particular project if they got resources for it. We're certainly a grant re-giving organization, the partnership itself.
So I'll just spend a couple of seconds here. You know, when you've made the commitment on the grant, we have to record it. So if you have a scholarship committee, for example, that's going to meet today, and they're going to make the final decisions and send out letters today to 4 students, giving them each $10,000 each scholarship. When that letter is sent out by email, then we're on the hook. And so we need to record those, even though they might not be paid for 1, 2, or 3 years down the road. Okay? So grants payable is interesting. It's when you make the commitment, not when you pay them. So if you give a 4-year scholarship and it doesn't even start till next year, we start to book that right away because we have that commitment, the piece of paper. And debt is debt. You know, as a nonprofit, if you owe funds, the current portion of the debt will show up here. The first year grants payable will show up here. If you go to the next page, you'll see that we repeat everything but accounts payable because you can have long-term accruals, long-term, you can have multi-year deferred income for memberships, and you can have multi-year deferrals on all these other things. You know, most debt runs multiple years unless it's a line of credit. Okay. I'm going to stop there, Deb, for like 5 seconds. Is there any question on assets and liabilities? Because we're going to net assets next.
You can type it or mute or unmute yourself, either one.
Because this next section is a little painful, but I think people are there, but I really want to talk about this, and then we're going to go look at some examples, okay? Okay, I'm going to go on. Is that okay?
Yeah, go on.
Okay, so in assets minus liabilities equal net assets. If this was for profit, this would be assets minus liabilities equal retained earnings. So we call ours net assets. And the problem with nonprofits is we have 2 big classes. We have without donor restrictions, unrestricted money, and with donor restrictions, restricted money. And notice how there's 2 pools in the donor restriction. We have temporary restricted and permanently restricted. I think most of you probably understand these buckets. I'll just give a quick definition. Permanently restricted funds are funds that we get in the door from a donor that are restricted by the donor, as requested by the donor, to not be used in the future, to be held in perpetuity to support something in the future. A lot of times they're endowments to support a scholarship, a fellowship, a chair, or something, you know. So in theory, if you wanted to give out a $5,000 scholarship every year in Deb's name, which would be a nice honor, wouldn't it be, Deb? Okay. We could call it Deb Fund, right? And scholarship for amazing people, okay? And we would need that donor to give us between $100,000 and $120,000, showing off 4 to 5% return every year. We could give that scholarship out in perpetuity. We would invest in long-term investments, and we would use the earnings off of it for a permanent endowment. Temporary restricted are where we get money or restricted by the donor, but it's spendable. Okay, and there's 2 types of restrictions. There's time restrictions and there's purpose restrictions. So using a very boring example, let's pretend you had a library. Somebody could give you a restricted gift to buy books. Okay, so you can only use that money to buy books if you have a library. They also could give you money to buy books over 5 years and say they're going to give you $2,000 a year for 5 years, $10,000 gift that has a time restriction, getting spread over time. And most grants are a perfect example of temporary restricted because almost all grants have both a dollar amount, a purpose, and a time restriction. So they're time and purpose restricted grants. Every once in a while you get a capacity building grant, but usually they're both tied in. Okay? Everything else is unrestricted. You can get an unrestricted gift from a donor, and any money left over from an exchange transaction, you know, a membership, a registration, a service provided, those monies are unrestricted. Okay? This is where operating reserves come out of. We've talked about this before in some of the other seminars, and we're going to do this in the last seminar some more. The health of an organization shows up in the operating reserves. Operating reserves are the liquid portion of unrestricted net assets. We've talked about this on our other webinars. Okay, these are very important concepts. Any questions here, Deb?
No, no questions.
Okay, perfect. Just a real quick aside as while we're doing financial statements, notice that nonprofits do look a little different from for-profits in two ways. Number one, the revenue and support needs to be split on the income statement. We have to separate support and revenue. Notice the revenue side is all exchange transactions. Offering consideration would look just like a for-profit, okay? And support or promise to give contributions show up on the left side. But we have to separate those. Okay. Oh, sorry. A government grant would show up here. A government contract would show up over here. A grant to increase literacy, $50,000 goes over here. A government contract to distribute 5,000 books to children would show up over here because we can measure deliverable. Literacy is hard to measure. The other thing is for expenses, we have to split expenses into three categories. We see this on audited financial statements. We see this on the 990, and it's accepted best practice for nonprofits. We split all expenses into programs, fundraising, G&A, or overhead. Okay. Now, let's take it. We're going to look at a balance sheet here in a minute, but let's just recap. A balance sheet is a point in time. So if your balance sheet comes out on June 30th, 2020, it's for that day. But if you're a 12/31 year-end entity, on June 30th, that will be your 6-month income statement. That covers 6 months. If you're on June 30th, if you have a June 30 year-end, your balance sheet is just June 30th. But your income statement would be 12 months, June 30th, 2020. Okay, and that resets at the next fiscal year. Okay, so you've all heard, you know, the balance sheet is divided into 3 sections: assets, liabilities, net assets. And usually the balance sheet has 2 columns, current year and last year. So we can do a comparison, and we'll see that here in a few minutes. And remember this formula: assets minus liabilities equals net assets. So you take all your assets, pay off all your liabilities, what's left over are your net assets. Or you can do the formula this way: assets at the top equals liabilities plus net assets at the bottom. And that's how we come up with the word balance sheet. Because you know how you always want to have that number at the top, and at the bottom of the page you're in balance. Okay? So let's see this little example. Now, Deb, I'm going to slow down here. I know I always get a complaint because numbers are hard to read in PowerPoint. I made this as big as I could and not too many lines. Is everybody okay reading this? This is sort of a generic balance sheet I just want to walk through for our first one.
Yeah. Mike, I think we did some of this on the last call, and I don't remember. Folks, is this looking new to you, or I go over these with Mike in advance, so I'm not 100% sure, and I want to make sure.
We'll get some new examples here in a few minutes.
Great. Okay.
Yeah.
It's just I know you do so many of these, and I go over them with you in advance, so I don't want to duplicate things, but I also want to make sure they get all the content.
No, we just want to, because we just went through all the descriptions on the balance sheet. Just want people to see assets are what we own, liabilities are what we owe, and net assets at the bottom. And you can see that they're in balance here. The reason I brought this back in, Deb, is because when we switch over to the other sheets, they're much longer and I can't get them into a PowerPoint. So I just wanted to do
Got
this.
Okay.
Okay, and just see here. And before we go, we're going to spend the rest of our time going through sample reports. Okay. Any question on the individual pieces of the balance sheet right now? Anything there? Okay, so now we're going to go to our samples. Okay. So give me a second. I'm going to pop open the first example. Okay, now there's two things you got to bear with me on. Number one, this is a nice example. I use this in my classes. We're going to look at 3 different ones of these. Okay, Deb? We're going to go slowly. We're going to spend about 2, 3, 4 minutes on each one. Okay. We would like people to unmute their mic here in about a minute. I'm going to make this small for a second. And everybody should get close to your computer. Get so close that your nose touches the screen, okay? You want to take a look and see. I'm just making it small enough so you can read it. And you can see that the assets are at the top, liabilities in the middle, net assets in the bottom. And notice this is in balance. I'm going to give you my way of looking at doing the 60-second analysis, but I want to see what comes off the page for you. Deb, can you unmute people? I would like to just unmute people. I don't care how much background noise there is. And I would like everybody to participate in this. I can't see you all. I can just see your names. But if you would unmute, I would like to go through and ask a couple of questions. Some of these are just going to be yes and no, and I'm not even going to know who's answering. And I promise to only praise people, okay? Today is like Friday. So no matter what the answer, I will say good answer, okay? So we're going to take a look at this. Okay, here we go. This statement's in balance right now. It got $3.7 million of assets, okay? It's sitting on a lot of assets. Take a look at this statement. Does this look like a healthy organization? Does something jump off the page here, either good or bad? What do you see on this? The ultimate question we're always asking ourselves, is this a healthy situation or is this an unhealthy situation? People see 3.7 million and they get, what do you think? Who would like to go first?
There's very little operating cash.
Very good comment. I always look at cash. I want to hear what you say before I tell you what I look at. Okay, another comment, please. Another comment. Notice how cash is so low for $3.7 million. They got 15,000 and another 120 is there in equivalence. Any other comments?
Just a lot of that 3.7 is in the building. If you look at the 1.7 million.
Yeah, exactly. A lot of their assets, not only in the building, but look at this. They have almost 2.5 million of what we call hard assets. It's mostly building, but property and equipment. We can't turn this into cash, okay, without selling it. And that's really hard to do. Okay, come on. There's about 3 or 4 more good comments. Keep going. Make sure you look at the top and the bottom.
Well, they have quite a bit of pledges receivable, too, in relationship to their cash.
Yep. So that they're sitting on 245,000 pledge receivable up here, but also look at the long-term pledges receivable. So together, people owe them $1 million. Are you comfortable why it's shown on 2 lines? Does that make sense to you? Who was talking? Who was that?
Oh, this is Jennifer.
Jennifer, can you see why it's on 2 lines?
Yeah, especially it would be helpful for a board to know what time frame it is.
Right. But you can at least tell, Jennifer, right, that they have long-term pledges. People have made multi-year pledges, right? Because if they're all due this year, they would all be up here at the top. Can you see that?
Yes.
Really good observation. Keep going. We're going to do 2 more of these after this, and it's going to keep changing, but I want to really spend a little extra time on this one. I'm not trying to be mean. I just want to see what jumps off the page at you because I could spew what I see. But
So I see debt, a good amount of debt.
Yeah, there's a ton of debt. So to me, They have a building that's worth about $2 million. Does everybody see that up at the top?
Yeah.
Mhm.
They have the building plus the land plus a little bit of improvements, okay? How much debt do they have on that building?
2 million.
2 million, right? And really the building could be underwater, right? Because it could be worth less or whatever, but at least the debt is almost equal to the building, right?
Mm.
Okay, very good. A couple more observations. Give me one or two more and then I'm going to tell you what I look at. These are all really good observations. Can I nudge you in a direction of looking at deferred income? Anybody have an issue with deferred income? Does that look funny to you?
It's under,
Remember the definition of deferred income. It's money we've gotten in the door, already received, that's for next year. And
Why is
look,
it a lot?
notice the deferred income's bigger than their checking account and their equivalents. It looks like they've used that money already.
oh,
Oh.
Does anybody have an issue with accounts payable?
it's a lot.
It looks like a lot, but what's it look like? And let's say this is coming from an organization that has a $2 million budget. So for a $2 million budget, 150 isn't really high, but I don't like it. Why don't I like that accounts payable?
No cash.
No cash, exactly. They're going to have trouble to pay that. And remember, what's not in accounts payable, you pay every 2 weeks.
Payroll.
Payroll. Okay. 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 I'm going to count to 10, and now I'm going to give you the way I do my quick 60-second look. You ready? 7, 8, 9, 10. Here we go. When I pop these things open, the first thing I do is I make sure that this number here, total assets, equals the total liabilities, net assets on the bottom. I just want to make sure the thing's in balance and there isn't a mistake in there, okay? And this is in balance, so that's good. I always then go to the net assets section. The one place you guys didn't go to, which is interesting. I am nervous about this organization because it's only got a little less than 300,000 of unrestricted. Do you see that?
Mm.
On millions of dollars. You know what I mean? And on a $2 million budget, that's really tight. Okay. And then I always go to see how cash looks to accounts payable. And then I go and look at, you know, some of the other lines like you looked at. And notice I do have some investments in here, but those investments I'm assuming are holding their permanently restricted and some of their temp money. You know what I mean? But we'll see. Okay. Everybody ready? Let's go to page 2. So what did I do here? Look at the top of the page. What did I add? Unmute yourself.
Previous year.
Okay, so 2019 did not change. Notice cash is still 15,000. Does everybody see that? Okay. Now, I'm going to make this smaller so we can see the top and the bottom at the same time. Okay, give me 1 second here. Okay, now we're looking this year to last year. Does everybody see that? The first column did not change. Question number 1, yes or no? Yes, this organization looks better. No, the organization doesn't look better. Does it look better or it doesn't look better now? What jumps off the page? Were they stronger or weaker last year? What's your guess? Stronger or weaker?
Stronger.
Definitely.
In the previous year, yeah.
Yeah, in the previous year. What makes you say they were stronger in the previous year? There's a couple of good indicators.
They had more total current assets. They had more total assets.
Yeah, a little bit, but go to my favorite area. First place, look
Yeah.
at net assets. What makes them look stronger last year when you look at net assets?
Unrestricted.
Yeah.
Very good. They were sitting on about 700,000, 6 plus 1, and now they're down to about 300. Can you see that?
Yeah.
Okay, that's a big drop for 1 year, right? And across the board, everything got a little bit worse. Does that make sense? Notice how accounts payable are higher. Deferred income is lower. That's less people paying early. Notice cash was higher last year. Even investments were higher last year. Can everybody see that?
Mm-hmm.
The only thing that really didn't change was their fixed assets, which shouldn't have changed too much. Does that make sense? there isn't like one positive thing to say going from this year to that. So do you see the change? So now, do you see the benefit of looking what I call two-dimensional this year to last year? And three-dimensional is this year to last year into other lines, you know, comparing lines. Because notice last year they were still in trouble. They had $500,000 in deferred income. You see that down here? And their cash is only around 300,000, the top two lines. Does everybody see that? Okay. Okay, we're almost running out of time. Okay, I'm going to be really mean to you and show you the next one. Okay. Now we're looking at a 3-year spread. Everybody got that? Let me just make it a little bit smaller and put it on the page for you. So where were they 2 years ago? Were they in a better position or a worse position 2 years ago? Go down here.
Better.
Yeah, take a look at their unrestricted.
Yeah.
So even though this is 3 years, does it make sense when I say over 2 years? It went from over $1 million, right? 1.1 million to 300,000. Does that make sense? Can you see that? So
Yeah.
2 years ago, you could probably say they were a strong organization. They had half a budget put away, right? $2 million organization. And notice their accounts payable compared to cash, totally different story, right?
Mhm.
Okay, still they're over relying on deferred income, but they had a lot more investments. But you see what I'm saying? They've really slipped in 2 years, haven't they? Okay. So what I want to say to everybody here is I'm not here to make you an accountant. What I am here to give you the confidence to pop open one of these and in about a minute or two to ask questions. That's your job. And to see how they answer them and to see how they smell. Does it smell good or does it not smell good? You know what I mean? And do you start to see? And make sure you do things two-dimensional, three-dimensional. Remember in the beginning I said, well, what if I show you my bank statement and I have $2 million? By itself, a line means nothing. You need to see that line compared to other lines. Okay? And just look at the stark difference between 2017 and 2019 over 2 years. It's really markedly changed. Now, if you just get blind to the total assets, which a lot of people do, it's like, okay, 4 million, 3 million, it's about the same, you know? But it's a huge difference between these 3 years. So, Deb, I'm going to do two things. We're right up on top of the end of the hour here. I can stay on. I just want to be respectful of people's times and other meetings. But see if there's any other questions. The timing was really good. We got through everything I wanted to cover and such. You're muted, Deb.
I'm watching to see if anyone puts a comment in the chat box. Did you want to mention anything on this webinar about when you use those reserves, or is that for the next one?
We're going to talk about that on the next one a little bit. Yeah, I mean, we're right up at 2, and that's a long discussion, and we're going to really get into balancing mission and financial health and using operating reserves. It's a big chunk of what we're talking about next time.
Okay. I'm not seeing any questions. People are also still unmuted, so you can ask a question verbally if you want.
Okay.
I think you're all unmuted.
I show people muted here. But
Yeah, I think maybe some of them
go somewhere
muted themselves.
Yeah. Okay.
But
and then you were gonna remind people of the time for the part 4.
actually, I'm going to ask Polani to remind everybody about the part 4 timing because she's the one who said it. Polani, can you come on and remind us that and also put it in the chat?
Yeah, I can and it will go in an email as well. But on July 15th at 2 p.m. Eastern, we'll have the next and possibly final webinar in this series. So yeah, hopefully y'all can join us, and we'll be sending out that registration sometime in the next few days.
All right. We'll send out the recording and the slides for this. And as Polani said, we'll send out the registration. And if you want to do a one-on-one with Mike, please send that request to Polani. She'll give you the schedule where you can register, and she'll give you the list of documents you need to do it, to meet with him, to make that the most productive possible meeting. And have a wonderful 4th of July weekend. And I hope you take some time off. I don't know if anybody's going anywhere, but even if it's a staycation, have a great time.
And we'll be doing
Thanks, you too.
operating reserves, using operating reserves, going back into more detail, balancing mission and financial reserve. And we're going to pull back in a couple of subjects that we have referred to during the other 3.
Great.
Perfect. Okay. Thank you, everybody.
Oh, good. I'm
you.
so, Mike, I don't know if you can see it, but Jennifer says this was, these webinars have been helpful along with the one-on-one sessions. So I want to make sure you know
Okay.
that. And
Thank
Mike
you
says
so
happy
much.
4th. All right. Take care,
Any
everyone.
questions? You can always email me too. Okay. Thank you.
Or email Polani and she'll get the questions to Mike if you don't have his email.
Yeah.
So take care, everyone. I'm going to
Take
end the
care.
recording.
Thank you. Bye. Okay. Is that timed out good?
Yeah. So I think we're good. Polani, how many new people have signed up for Mike at this point? Nobody. Can you send me the list of everyone who indicated they were interested but haven't? Well, actually, why don't you follow up with them one more time and then I will?
Yep.
Because I know they need it. I also know they're overwhelmed and we just have to keep nagging. But I know they want it. People were really enthusiastic about it. Did the Children's Partnership hasn't reached out for it, right?
No, they reach out to me. Myra was somebody who, because when I reached out to them, she was actually very excited, but didn't have capacity at the time. But she's like, if you schedule more sessions later, then I'm good. We did schedule more sessions and they never signed up, but I understand that they're so swamped. So I will reach out again to them. And then there was another, oh, I wish I could remember off the top of my head, but there was definitely one other person who said that they were really swamped, but really wanted to do it as well. And I can't quite remember who it was, but either way.
And we've I've had I'm keeping a detailed inventory, Deb, or like who I talked to, the times. I have notes from each one. I mean, the notes are a little bit confidential, but I also can send you, I keep a detailed,
Right.
Excel. So I've only been working with 1, 2, 3, 4 organizations, and only one of them we've gotten through both parts.
And I know Jennifer's ready to go to the second part. I know that the other people need it. I mean, we did a survey. We know who they are that wanted it. They are just swamped because it's such a crazy time. But I think we need to keep pushing them because it will make such a difference to their financial health.
Yeah, and like I said, there's no deadline on this, you know what I mean?
Right.
Because everybody needs help, and the worst thing to do is force it on them when they're not ready or they're not concentrating, But it's been good.
Yes and no. Sometimes they're not focusing on it and they need to be, right?
Yeah, I think, that's a good point too. The other thing is 1 or 2 of these ask for another session. So if other groups aren't going to sign up, you can assign other sessions to those groups too.
We can do it even if other people do. If other people want an additional session, so long as you see value to it, I'm paying for it.
Yeah, we have 2 Jennifers. So Jennifer Ferguson were rescheduled.
Right.
Jennifer Dangle.
Yeah, Bevan Dangle.
Yeah, she wanted to know, but I told her, I just said to work through you guys,
Right. Can you, Polani, reach out to Erica Taylor at ACY and let Erica know that she can have a session with Mike and that the interim ED can have a session when they come on board.
Okay.
They are particularly in a fragile position, and so I particularly want to make sure they get whatever help they need.
Yeah, I know. I have a note here that, I just wrote down possible 3rd session. That's all I said, but.
Right. Yeah. But I told Jennifer that before she left, but I'm not sure that word got to Erica, who's the temporary interim until they hire a longer term interim.
How well the transition went. Yeah.
I mean, I know Jennifer and Erica work together really well, but I also know that it's a crazy time. So, for example, she might have been told that, but not have the right email contacts. So, Polani, if you could reach out to Erica about it, that'd be good.
I can do that.
All
Okay,
right.
so I keep this going on my computer. Sometimes I print it out because people call.
Right.
You know, I keep a run. As soon as I'm done the session, I immediately put all my notes into the database, so I have it.
You know what else, Palani? I'm going to pull down the list of participants and send it to you.
Mhm.
And if you can look at them, we opened this also to like people who needed this for career development who aren't necessarily doing this right at the time, but most of these are financial managers for their orgs. Can you cross-check it against the people who said they were interested originally and reach out to the others and see if they want the one-on-one, the ones who've been on the webinars but didn't originally sign up for one-on-ones?
Yeah, I can do that.
Okay, let's do that too, because I really want to make sure that we give them all the support they need. All right.
And then just
yeah.
one thing, Mike, you have your session with Jennifer Ferguson on Monday.
Yeah, I have that down.
Yes,
Yep.
and you have everything you need for that, but certainly let us know if there's anything else.
She knows she still owes me a couple things. I mean,
Oh, does she? I saw she sent some documents. Was that not everything?
she yeah, I'm trying to remember. She sent the documents a request, but she's still working on a worksheet. I mean, she'll get as far as she can.
Okay.
We're ready.
Okay, because I sent you something she sent me earlier this week, I think.
Yeah, I got that. Yeah.
Okay.
And she knows we've been going back and forth. She still has to work on the rolling budgets and stuff. But we're good.
Okay, great.
Yeah.
All right.
So, yeah, we'll just keep an eye. I know, I can't remember how many sessions you purchased, right? You have a lot to go, I think. Yeah.
I'll go back and look and I'll send you an email with it. We're nowhere near it. I know that. What I think we did was enough for 16 organizations.
Yeah,
So
I believe
we've got plenty of room.
Yeah, because 16 times 2 is 32. Yeah, because it's 52 for everything. Yeah. Yeah, that's what it was. There's 16 sessions. And right now we've got 1, 2, 3, 4. We only have 4. So we got 12 open. If anybody takes extra sessions, you know, we would do it, you know.
I mean, I can go over the 16. That's not the problem. The problem is people are swamped, but they need to do this. The other thing, Mike, is I assume you saw that people who didn't apply for the PPP, the time just got extended and there's still money in there. I don't know if you saw that.
Yeah, you know, I don't get directly involved in it, but there's still doors open. You know, we should be encouraging people to, that is a one-time thing.
Oh, is it ever? So I sent an email out today telling people that if they hadn't applied for it, they should apply for it. And I'm wondering if that'll get them more focused on finance in general. Palani, the PPP is the Payroll Protection Program. It's part of the coronavirus response. And it's a loan that small businesses and nonprofits can apply to, which if they spend it on payroll and rent and utilities, turns into a grant.
It's literally, it can be dollar for given.
Right.
It's basically an unrestricted contribution.
And a bunch of our members did apply for it, but I think some of them didn't because they didn't think the money was there. And so I'm still pushing it because there's this new window for another month. And I just think that might get them thinking about finance more in general too.
Yep.
So that's what I'm hoping.
So Children's Action Fund is the one I did too. It went really well. They're a well-run organization. They're bigger.
But
That's
Children's
pretty
Action
cool.
Alliance in Arizona.
Oh, Children's Action Alliance. Sorry, I said that wrong.
Yeah, they're good.
They
But-
did. We went really well. We're done. So that one's crossed off the list. Everybody
Yeah.
else is open.
She's a new ED though, so I know that she felt that this was extremely helpful to her. Oh, you know what else, Palani? I need to send, we now have 1, 2, 3, besides Maryland, did Washington State or Nevada work with you already, Mike?
No, let me just give you the name, and I have to do a 2:30, so I have to jump off here.
Oh, okay,
But ACY, Advocates for Children and Youth,
right.
CCA, the Schuyler Center for Analysis and Advocation, Children's Action Alliance, we just said, and then the last one is Jennifer Ferguson, Arkansas Advocates for Children and Families.
Okay, so we have two organizations with brand new EDs that might also want to, brand new EDs. I'll ask them if they want to
I gotta go sign in for another. I gotta do one more before I lose my voice.
go. So don't lose your voice. Have a great weekend.
Yeah, you guys try to rest up. Hope you have a good weekend.
I'm
And
gonna
when we
try.
come back, can you make sure this crisis is over by the time we get back on Monday?
If only I could, but I can't. No, actually, it's just blowing up and getting worse. And then in the kids' arena, there's the whole thing about, do they send the kids back to school, which is blowing up a separate battle.
I am so fearful, Deb. I am so fearful right now. There is no light at the end of the tunnel. There isn't even a glimmer. And in fact, they're selling false hopes right now.
Yeah, they
In
are.
my opinion. And they're putting people's lives in danger. Yeah, I got to go.
Yep.
I don't want to get more depressed than I already am. Okay.
No, the only thing is, I think more and more people are realizing that and taking precautions they weren't. And so I think even though the governors and the president aren't doing anything, people themselves might. I saw a study saying that actually most of the lives that were saved were from people starting to take precautions before the governors did stay-home orders the first time. So maybe people will just be more sensible. That's the only light I see.
No, it's just learning the lesson at a very high cost.
Yep. Yep. And it's
Yep.
in lives.
Yep.
All
Okay.
right. Take care. Yep. Bye-bye.
Bye.